The top story this morning, after months of complaints by President Donald Trump, the Federal Reserve has adopted a patient stance on rates. The Federal Reserve signals it's done raising interest rates for at least a while, and the central bank has also decided to be flexible in reducing its bond holdings. Chairman Jerome Powell said that while the US economy was in a good place, slowing growth in China and Europe and Brexit trade negotiations and the effects of the 5-week US government shutdown had sent conflicting signals on the outlook. The FOMC dropped previous language calling for further gradual increases in interest rates and opened the door for the next move to be either up or down. President Donald Trump also tweeted about the stock market's gain on Wednesday, calling the Dow rise past the 25,000 level tremendous news. Now, building on to the story, we have Sarah House, senior economist at Wells Fargo Securities, joining us on the phone line. Good morning, Sarah. Fed indicating that they will remain patient on future rate hikes. Do you think that the now Fed is looking concerned about global growth?
Well, I think that's certainly the takeaway from what can only be described as a very dovish stance to policy coming out of yesterday's meeting. So they not only removed their expectations of, likely that we'd see some further gradual increases, but said that they would be patient with further adjustments with no real clear indication of whether the bias of those further adjustments would be up or down. So it is bringing some questions as to whether, is this just a pause that a lot of folks were beginning to expect, or is this potentially the end of the Fed's tightening cycle?
Sarah, hi, morning. The Fed chair also talked about that the case for further rate hikes is also weakened from here on. So for the year, do we expect the Fed to hold on to a dovish policy?
Well, I think, it's kind of tough to decide which way they're going to stay, just given what's been a pretty sharp about face just over the past 6 weeks, where even heading into arguably more weakness in December, they decided to raise rates. Markets have come back. Financial conditions have eased a little bit in recent weeks. We've been missing some of the data due to that government shutdown, but we've gotten all of the private sector data as well as a lot of the labor market data as well, all of which continues to look pretty good. And so, I think there's certainly still the possibility that they raise rates later this year, but the overall stance does seem to be much more conservative than what we saw just 6 weeks ago.
Okay, but what does it say about the liquidity condition in the US market? And of course, Cheryl had just touched upon the fact that it does also flag off the fact that Fed is finally getting increasingly jittery about the global growth condition also. But internally, how is the liquidity situation looking like, and how is it likely to play out post the policy stance change?
Yeah, well, I think there's still a lot of questions over liquidity in the system due to the Fed's runoff of the balance sheet. Still, some questions over how much of this is directly tied to the balance sheet versus just general rate tightening. But I think given that we've never done an unwinding of quantitative easing before, we're certainly seeing that the Fed realizes that they do need to be more flexible. They're not sure entirely how this is all going, and so they do need to make adjustments as we go, especially if it and overall probably err on the side of caution. And so I think they're laying the groundwork for those adjustments into the balance sheet runoff. On the second factor about just the global growth concerns, I think that has been certainly one of the changes we have seen over the past couple weeks, where we continue to see deterioration out of China and to some extent also the Eurozone. And so I think there have been increased concerns that could seep into what we're seeing here in the U.S. And so that does give reason for that more cautious outlook here from the Fed.
Okay, market watchers were also a bit surprised by Fed's latest signal on its balance sheet unwinding. Does it suggest that they're closer to completion ahead of target?
Well, I think that was one of the big questions of really what is the end of the balance sheet normalization really going to look like. I think we did get a little more information on that today than some folks were expecting, just in terms of they affirmed that yes, we are sticking with this floor rate policy. We're not going to be doing active in the market, doing open market operations on a daily basis. But there's still a lot of other questions to be answered regarding just, okay, what is that ultimate level of assets that they're going to be holding? What's the timing of that runoff? And also just what's the composition going to be in terms of not just the treasuries relative to mortgage-backed securities, but also just the maturity profile of those treasuries. So I think they're laying the groundwork for those moves, but there's still a lot of information that's needed.
Right. Just another thing that I'd like to touch upon is that while the markets have been taking a sigh of relief following Fed not changing their interest rates, not changing their stance, rather turning more dovish, does that also now comes with some caveats, comes with some underlying bad news for the economy in the medium to near term?
Well, that's a good question in that, okay, the Fed does seem to be more more supportive, but at the same time, if it's because that there are risks on the horizon, it's maybe not a purely good news story. I don't think the overall environment has changed that much in 6 weeks, where the underlying economy looks significantly weaker relative to what the Fed does. So in many ways, I'm not surprised by the market reaction, just given really the shift in Fed policy stance we've seen relative to the actual economic situation here in the U.S. and even factoring in that continued slowdown abroad.
Thank you, Sarah, for joining us this morning and giving us your view and breaking it down for us, the Fed policy and what the change in the stance means for the economy and the markets.